I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Luke Ellis. He runs Man Group, one of the world's biggest hedge fund managers. His firm once supplied rum to the Royal Navy. Now it's a giant in quantitative investing, using data and algorithms to make money. Luke competes with the billionaire titans of the hedge fund business, not just for returns, but for talent too.
This shouldn't be about how much money you can make. We're very lucky to work in an industry where you get paid very well. It should be about how much value can you generate for clients, and what's a fair proportion of that do you get?
Luke's mild manner belies some strong opinions. We talked about the right and wrong culture for a hedge fund, why many asset managers face extinction, cutting-edge research on the quant frontier, where he wants to expand. Here's my conversation with Luke Ellis. Luke, you've got a tough job running a public company in a business, the hedge fund business, renowned for its secrecy and dominated by winner-take-all billionaires. What's your secret to survival?
Well, I don't think of it as that tough a job. It's rather fun. So I ran a private business in the hedge fund world, and I now run a public business in the hedge fund world. And honestly, we spend more time on shareholder issues running a private company than we do running a public company. Clearly, I have to look after the shareholders' interests and do everything there. But when you have a private company, it's one thing if it's a single person dominated company, as many hedge funds are, but most end up with multiple partners, and then you worry about transitions, allocations of equity, those sorts of things. As a public company, we don't really have those issues. You just have a very clear thing as to what goes to the shareholders, what goes to the employees. And most importantly, asset management, if you deliver for clients, everything else works fine. If you don't deliver for clients, the rest doesn't really matter.
Man Group has made what you call a massive bet on technology and quantitative science. Why?
Because it's the future of the asset management business.
Simple as that.
The future, basically. It's the future of most industries, but any thought-driven industry. So what we know is technology finds some of the manual tasks that humans are good at to be really difficult. But processing data, technology finds incredibly easy. And asset management is at heart. I mean, it's a thought business. It's about processing information. And computers are really good at that. And so, I think technology is the future of the industry. There are elements where humans can still do things that computers can't do, but we let the humans focus on those elements, and everything where the computers could do it, we empower the computers with humans doing the programming, obviously, to be able to do that. And I think it's the future, to be honest.
Do you consider yourself a quant?
That depends who's asking. So I have a maths degree, so I ought to be okay. I've managed a lot of quantitative businesses. I grew up in the equity derivative business. That was my sort of swaps and equity derivatives, my formative years.
You ran that business for JP Morgan, if I'm not mistaken.
Yeah, I did indeed.
Your firm competes for assets, for returns, and crucially for talent, with a number of the smartest, most innovative, and successful investors of the past quarter century. I'm thinking of Ray Dalio, I'm thinking of Ken Griffin, Izzy Englander, Jim Simons. And furthermore, they've all got really deep pockets. Is that a fair fight?
We seem to be doing all right in that fight. It's the way I would say it. So yeah, it must be a fair fight. Look, I think one of the realities of all of these things is, in those private businesses, it all becomes about the individual, becomes about the person with the name on the door, and they get the massive rewards, but the money is not run by the individuals, it's run by big teams. There are more people at Millennium or at Citadel than there actually are at Man, interestingly. But, they're both in the sort of couple of thousand people, we're 1,500 people. It's not about the person at the top. My job is to get the best out of the team, as is Ken Griffin's job, as is Izzy Englander's job. They're not running the money. And so, it's all about, can I attract, retain, empower smart, interesting people who can run the money and do the creativity for clients. And, we do a pretty good job of that. There are some people who, get attracted by sort of very high short-term pay offers, but that's okay. It's a business, right? The answer is we have a lot of people who've made a career, who've built a life at Man, who like the fact that we give them a great place to operate amongst people who behave in a high-class way, that we look after money for, as I mentioned before, people that really need us to generate returns. So I think we have a pretty good offer to very smart people, and the numbers sort of speak for themselves.
Luke, I'm fascinated by the dynamics of compensation in your industry. Hedge funds are famous for paying top dollar, but I ran some numbers, and I was surprised to find that the average Man Group employee earns less than the average Goldman Sachs employee. How's that possible?
I don't know about it on a relative basis. Look, I think that what's really important, and I think it's something that people forget all the time, is the firm doesn't pay the employees. The clients pay the employees. The only way that we get income is from our clients, and it's from delivering value to our clients. If we do that, then there's a question of how much we give to the employees, how much we give to the shareholders. We don't have the single sort of original founder owner who takes the multi-billion-dollar check. That check, instead of going to the founder, goes to the shareholders. We think we pay people fairly. We think we pay them for the value that they generate for clients. But I don't think that, this shouldn't be about how much money you can make. We're very lucky to work in an industry where you get paid very well. It should be about how much value can you generate for clients, and what's a fair proportion of that do you get. And I spend lots of time, and I think we've built it into the culture, to get everybody to think first about delivering value for clients, and then accepting that they'll get treated fairly out of that, and they can build a long-term career with that.
Well, the economics at a top-tier hedge fund can be incredibly lucrative. As much as half the carry, the investment profit, goes to the manager and his team. It adds up to millions, sometimes tens of millions of dollars in a given year. Can you compete with that?
Well, I don't think that it's the right thing to take half of the profits for the manager. I think that the client is the one taking all the risk, and the client should get the majority of the rewards for taking the risk with that capital. At the end of the day, while you might have some money invested in your fund, the clients, if you lose money, the clients lose that amount of money, and the managers lose the opportunity to get fees. That means the client should get the vast majority of the profits from it. What we offer people is a culture where they can work with colleagues in a collaborative, engaging environment, where they can feel like they belong, where they know they're doing something that's not about making a billionaire a bit more billion-y. We look after each other. We look after our clients. We look after the people. We do the right thing on diversity. We do the right thing. We are very strong in not accepting bad behavior and throwing people out of the firm if they don't behave up to the standards we have.
Luke, one more question for you on compensation. You're well paid on a relative basis. Let's say an absolute basis. $3 million at least in 2020, and you're donating your cash bonus to charity. I commend you for that. But the best paid hedge fund boss last year, Chase Coleman, made 1,000 times more than you, $3 billion. And the top 15 earners in the hedge fund business collectively made $23 billion. Is that right?
That is a deep and profound question. Look, one of the things that always, whenever you get to this time of the year, and we're a public company, so my compensation is 100% transparent, and I get two sets of phone calls, both of which say the same thing. I can't believe what you get paid. From my wife's friends, I can't believe what you get paid means how much. And from my hedge fund friends, I can't believe what you get paid means how little.
Well, let's take the flip side of that. Should anybody be able to make $3 billion a year doing anything?
So I think that you've got a couple of bits to that. One is, do I think that tax rates should be higher above certain levels of income? Yes, absolutely. Do I think that the rewards for successful entrepreneurs can be and should be very large? Yes, I do, absolutely. Right. And the answer of most of the successful hedge fund managers you talk about that are in that top 20 of compensation, they are all entrepreneurs who've built businesses, and well done them. And then I think it's really incumbent on people to do good things with their money. Piling a bigger and bigger pile of money in your bank is a really pointless exercise.
25% of your senior management ranks are women, and you're committed to raising that number to 30% in 4 years. What's the biggest obstacle, Luke, to gender diversity in your company and in your industry?
The biggest obstacle is what people did 10 and 20 years ago. So, when I got to Man, I would say there was a large amount of misogyny in parts of the management team and even in the HR department. And so, no surprise that they weren't building the cadre of future leaders. And, so we had to change all of those cultural aspects first and then start building on the people we've got and encouraging, promoting. But you have to get all the behaviors right. It's not just about, can we go and find some people and chuck them in a seat, right? I think one of the worst things people do is they take their stars and they over promote them. There's somebody or other's law that's about, you get promoted to your level of incompetence. Well, that's bad management to do that. What we do is to try to encourage them and show them opportunity and try to get absolutely the best out of everybody that works for us and make sure there are no barriers in the way to letting people succeed. If you do that, the numbers will go up. So when I took over as CEO, that senior management stat was just under 19%. It's about 26% today. And yeah, I've committed to keep it going up at 1 or 2% every year. I'd love it to go up faster than that. But the reality of it is, it just isn't because of the raw material in the industry. I don't think it helps if we sort of ran out and tried to hire 20 of BlackRock's senior women to come and work for us to say, hey, look, we've increased our senior women percentage, because then BlackRock number gone down. What we all need to do is to help the best and the brightest diverse talent in the industry to achieve what they're capable of.
We hear a lot about the virtues of scale in asset management. And Man Group is either the second or third largest hedge fund manager after Bridgewater. Is scale an advantage?
In simple terms, you can deliver betas from the market, and that is a valuable source of return for clients. That's what BlackRock does incredibly well. It's what Vanguard does incredibly well. And that's great. And if you want the index return, those are the right passives, are the right way to do it. We're in the alpha business. So we're about trying to generate excess return, either in an absolute basis or in a relative basis, but it's all about trying to use skill to add value and to generate better returns or better risk-adjusted returns for our clients. I don't think scale for scale's sake is a good thing. So in the beta world, where it's really about the maximum amount of assets that you can spread your costs over, it's a slightly different case. In the alpha world, if you get too big in any alpha process, the market will find what you're doing and the alpha will dissipate fairly rapidly. There will be some mega-sized players who deliver mostly passive and some things that are passive plus a very small amount of alpha. And that's everybody chasing BlackRock. And then you really do have to be in the trillions in order to compete. There won't be a dozen of those players. there will also be some people who are all about alpha. And while the assets under management will be a way of describing it, it's the sort of amount of alpha that you can generate that really matters. In the high alpha business, the reality is the price that clients pay is really a price per unit of alpha. The more alpha you generate, the more fees clients are happy to pay. And it's relatively proportional, and that proportion hasn't changed that much over time. The hard thing is generating alpha. It's a very competitive business, and everybody would like to do it. And so you need to dedicate resources to it. Our view is the number one resource you need to dedicate is technology. And so, the technology and the quants that go with it let you generate what is a growing scale advantage. But the scale here is really in compounded alphas, is in lines of code, if you like, that creates a barrier to entry for the average person trying to compete.
You wouldn't describe Man Group as an alpha factory if you didn't believe you were delivering excess return. What about the rest of the active management industry? Is it living up to that obligation?
I think there are too many different active asset managers in the world. I think we will end up with less managers over time, without any doubt. And there are a lot of people who the fee load that you used to be able to get 5-10 years ago for running a sort of pretty ordinary fund that outperformed 1 year out of 4, you could still charge 50 to 100 basis points of fees. That's an unreasonable fee load. And I think those business models won't survive. I think the ones where people can generate alpha, there is more demand for that alpha than there is supply. So, the fees are very stable, and the business model, I think, can work and compound over time. We see our opportunity over the next 5 years, 10 years is taking market share, but I think there's lots of room for taking market share.
Luke, hedge funds are infamous for their fee structure. Some managers can still charge 2 and 20 or more. But your fee margins have been under pressure for years. Why is that?
The thing that really matters is for the proportion of the alpha you generate that you charge in fees. That's what really matters to clients. So to us, it's really important that most of the alpha goes to the clients. We think they're the ones who take the risk. They should get the majority of the alpha. So the client gets something between sort of 65 to 75% of the alpha generally. So the client gets the first call, and they should get the first call. The second thing is that then gets you to an amount of fees that you're charging. And what then matters is what our cost of production is to work out whether we have a good margin for the shareholders. The reality is asset management still has very good margins in. So, we can do both very profitable 2 and 20 business and very profitable stuff that's at a 50 basis point flat fee. It's just a different thing you're getting at those different price points.
The never-ending search for alpha reminds me of Star Trek, right? Boldly going where no one has gone before. Tell me about some of the bleeding edge stuff your quants are working on.
Some of the really interesting work on the quant side is around natural language processing. There's an enormous amount of verbiage out there in financial markets and in the broader world, which might have alpha in it. It's beyond human capability to read all of that stuff. But actually, it's the sort of thing which modern natural language processing can really get on top of. And yes, they can even deal with emojis. They can even work out whether a rocket ship pointing up means something different than a rocket ship pointing down. And there's a lot of really interesting opportunity there, both to generate pure quant alphas and also to save the discretionary portfolio managers a huge amount of time so they can concentrate on the thing that they do better than computers, which is interviewing people. So that'd be one type of area. Another type of area is, we take quant processes into parts of the markets or the sort of asset world that other people sort of don't really think that they apply. And you can apply quant processes in almost any asset class, or actually any asset class, if you understand how to make it into a liquid tradable instrument. So, sort of when we had the recent snowstorms in Texas, and there was lots of sort of news headlines talking about the difference between the grid in Texas with the East Coast, the West Coast, and somewhat surprised. We have been trading those three electricity markets independently using quant processes for a long time, and to good effect, making the markets more efficient and also earning our clients a return.
Since you brought it up, did you make or lose money in the Texas deep freeze?
Sometimes commodities can be the slightly ugly stepsister in financial markets. The sort of the headline all goes to equities, then you get the bond market, and somewhere commodities can be left behind. But the last 3-6 months, you've seen some very significant movement in commodity markets, in a wide variety of commodity markets, and they trade really quite independently. And so that has been good for us. What we like are things that move, and what we like are things that move independently of each other.
Is there consistent money to be made in quant off the boom in retail stock trading, the Wall Street bets phenomenon?
Well, I certainly don't want to pick a fight with our friends on Wall Street bets. But I think on average over time, the more different players there are in a market, the better that is for people like us and for quants. And if you look across a wide variety of markets, you could see that on average for quants, the more retail participation, that has traditionally been good for them. Clearly, there were some people got the wrong side of the Wall Street bets phenomena in the last few months. And some of that was quant, mostly that in the end was around some of the discretionary people with over large short positions on individual names. I think I think increased participation is good for us. Increased volume in markets is good for us. Increased volatility is good for us. We've all got used to this idea that there's these sort of incredibly low volatilities. And it all, I think, starts from basic economics, that when you have all governments and all central banks following roughly the same policies, economic policies, and those policies involve very high future transparency about what they're going to do, and they are all essentially cooperating, which has been really what we've seen for the sort of most of the 20 years of this millennium, the first 20 years of this millennium, then it's no surprise that we got less and less economic volatility. What you've seen starting, well, you can choose your starting point, but I would say starting with Trumpism, but then certainly exacerbated by what's happened in the pandemic, and obviously in the UK, exacerbated by Brexit, is that you've got central banks operating very separately to each other, governments following quite different policies. And so the place where we are in coming out of this virus is very different in different countries, and the speed of it working is different. And so, and what countries have done to their balance sheets quite different. And so I think both intra and intra country economic volatility is going to be much higher for at least the next couple of years. And that's going to lead to more volatility in markets.
Does Man Group have a strategy for trading Bitcoin?
We trade the futures, and we started to trade the physical. The question is how scalable it is over time. How liquid do these instruments stay? How long do they stay liquid for? One of the things you see is people tend to think that liquidity is a sort of monotonic upswing, so that they see something, and if it gets a bit more liquid, they just assume it will keep getting, and it'll never get less liquid again. And what we've seen in many contracts around the world in different things is they can go through a period where they're super liquid, and then they go out of fashion and you don't see them again. So a couple of years ago, we made a lot of money trading egg futures in China because at one point they were trading, I believe, $5 billion a day. Eggs, like the thing you boil for your breakfast. There was a lot of people speculating in that market. It made it a very good market for our models. But, it didn't last that long before people stopped looking at it. It went back to being a hedging contract for farmers, and suddenly it's not a very interesting market. I think one has to temper the excitement about cryptocurrencies and how much you can do in those markets until you could see where there's real liquidity.
Luke, machine learning and artificial intelligence were supposed to revolutionize quant investing, but so far they haven't, at least as I understand things. Why is that?
When you look at financial markets, the vast majority of what's happening is just noise, right? There is an enormous amount of trading or movement in share prices intraday, one day to the next, even over time, which is just noise flowing through that. And artificial intelligence has a natural tendency to want to try to create a pattern in everything. And so it creates a pattern in the noise, but that noise is not it's noise. So there isn't a pattern. There's a short-term thing you can apply it and then it drops off. So that's a tough problem for artificial intelligence and machine learning.
Are you surprised at how poorly some quants, even the top-tier firms, did in 2020?
I think that there are two enemies of long-term success in quant investing. And it doesn't matter how good your brand is, because it's not about your brand. The first is taking too much money in. And if you take too much money into a strategy, basically what happens is the market finds your footprint, and then your alpha turns into a risk, not a source of return. And secondly, if you don't continuously invest, it's very easy to come up with some good ideas, raise some money, sit back and count the pennies and start deciding whether you want to buy yourself a plane or a boat. The trouble is markets are continuously evolving and competition is continuously trying. And so if you're not consciously trying to innovate and you're not investing in that innovation, then what will happen is your alphas will decay. Suddenly you're left with a whole lot of money without alpha, and then you end up making some big losses.
Quant, however, can be confusing if we looked at it as a spectrum. And at one end of the spectrum, I'll put Renaissance Technologies, the firm founded by Jim Simons. And at the other end of the spectrum, I'm going to put AQR, run by Cliff Asness. Where does Man Group fit in between them?
We would love to be 100% idiosyncratic alpha. It's just incredibly hard. And you always find a certain amount of factors sort of slip into what you're doing. And we have the longest and most successful track record in momentum investing in futures markets. And, why wouldn't we continue doing that? It would be silly to stop it. It was good. So, I think on your spectrum, we would be 70 or 80% down towards the end that would have a medallion and a 2 sigma and less so at the what I would think of as more the AQR Bridgewater end.
It makes me wonder, why hasn't Man Group used its technological prowess to build a business in passives? You could.
We could. I think two things to it. One is, it's an Uber scale business, and maybe we coulda, shoulda, woulda done that 15, 20 years ago. And, look, the man had the cash on the balance sheet to buy BGI when BlackRock did and passed and BlackRock won, right? That's a, coulda, woulda, shoulda moment. I think but now it's too late to start a passive business. I don't think you could compete. And secondly, our quants are, they have a very, very high intellectual standards. They like to work on complicated problems. And passive is a very important asset class for clients, but it's not a very complicated problem. And if I they like to be thrown really complicated things. When you throw them a Rubik's Cube, they debate as to who can do it in under 5 seconds, which is a quick time. But it's not intellectually interesting to our people.
If Blackstone can do hedge funds well, why can't hedge funds do private equity well?
You have a couple of big challenges. One is an awful lot of the private market businesses that we've looked at didn't, to us, have any alpha. That a lot of private markets is basically charging a beta. I mean, they're delivering a beta and charging an alpha fee for it. That's what hedge funds used to do, but don't get to do anymore. It's what long only used to do and don't get to do anymore. And I don't think that is sustainable. So we want to find one where there's actual alpha. And secondly, the public market is putting fantastically high multiples onto private market businesses. And so, it's difficult to get the price element to work. But again, we won't try and chase something. We will do it if we get an opportunity.
When you say private markets, are you referring to private equity, private credit, real estate, all of the above?
Yeah, exactly. All of those. Things where there isn't a price on a screen available once a day.
ESG, or we could call it responsible investing, may be the fastest growing category in asset management. How much of an opportunity is there in ESG for Man Group?
The business opportunity in asset management in ESG, the reality is all the money going into ESG or into responsibly invested assets is transfers from money that was already in those strategies without the ESG label, without the RI label. And clients aren't paying more for ESG or RI. They're looking to pay the same, but they're looking for a differentiated outcome. The rate with which so many people want to run around saying that they are now an ESG or an RI fund makes it inevitable that many of them don't really understand what that implies. So people are trying, and we're going to have to keep moving quickly as an industry to get better at all of this stuff, but we have to do it.
Is Man Group going back to the future? A year from now, will all your people be back in the office?
No. A year from now, everybody who wants to be in the office will be in the office. My guess is in the new world, it's slightly guesses, but probably 20+% work from home permanently or as close as permanently. My guess is 30%, maybe a bit more, work from the office permanently. And my guess is a big chunk now work from the office 3 days a week or something. But my view is what we want is to be the most productive we can be, the most creative we can be. People are more productive when they're happier. And so if you can create the environment where they can be the happiest they can be, then you can get the most productivity out of them.
Luke, it's a pleasure. Thank you very much for taking this time to talk to me.
It's been great fun, Eric. Thanks.